Bitcoin's market is at a crucial tipping point, with major shifts in both demand and supply dynamics. In this video, I'm breaking down the current state of Bitcoin and why we might be on the verge of a significant price movement. We've seen profit-taking slow down, with retail investors snapping up nearly twice the amount of Bitcoin being mined. Plus, the market is in a historically tight price range, signaling that big volatility could be just around the corner. Stick around as I explain what's happening on-chain and what it means for Bitcoin's future. First up, we saw net capital inflows spike as Bitcoin hit $100,000. Investors were locking in some serious profits during that rally. But here's the interesting part. These capital inflows have since slowed down as the market consolidates. Essentially, there's been a reduction in sell-side pressure, which means less new money is needed to keep prices stable in this range. Looking here at the realized cap, it's hit an all-time high of $832 billion and is growing at a rate of $38 billion per month. This is a key sign that more value is being stored in the network. The net realized profit and loss metric shows us the magnitude of capital flows in dollar terms. Right now, as the market adjusts to the earlier profit-taking frenzy, we're seeing this metric gradually normalize. What does that mean? It suggests that most of the coins moving on-chain aren't locking in huge gains or losses relative to when they were acquired. Back in December 2024, profit-taking hit a peak of $4.5 billion. That's massive. But since then, it's plummeted to just $300 million, which is a 93% drop. When we combine realized profits and losses, the total has dropped sharply from $4 billion to $1.4 billion. That's a 65% decline. Even so, the current value is still high compared to historical averages, highlighting the strong day-to-day demand absorbing all this activity in the bull market. Now, let's shift gears to the supply side. Using metrics like CoinDay destruction, we can confirm that sell-side pressure has eased up. The binary CDD metric shows us when long-held coins are being spent. After a period of heavy selling late last year and into January, this has cooled off. This indicates that many investors who wanted to take profits have likely already done so. We're also seeing long-term holders slowing their selling activity. During the December rally, their total supply took a big hit. But in recent weeks, this decline has stalled, and we're now seeing signs of accumulation. This tells us long-term holders are shifting back into hodling mode. Centralized exchanges, where most trading happens, also reflect this trend. Inflow volumes have dropped significantly from $6 billion to $2.8 billion, which is a 54% decline. For long-term holders, exchange deposits have fallen even more dramatically, from $500 million in December to just $90 million now. That's an 83% drop. This data reinforces the idea that most profit-taking within this price range has already happened. To dive deeper into the supply and demand balance, we can examine how different investor cohorts are adjusting their Bitcoin holdings, normalized against the volume of Bitcoin mined. This method shows how much of the new Bitcoin supply is being absorbed by various groups. For example, the shrimp crab cohort, which are retail investors holding less than 10 Bitcoin, absorbed around 25,600 Bitcoin in the past month. With miners producing 13,600 Bitcoin in the same period, this group alone has taken in nearly 2 times the newly minted supply, showcasing robust demand from individual investors. Meanwhile, volatility remains remarkably low, with the 60-day price range near historic compression levels. Such tight ranges have historically preceded sharp price movements, either as early bull market rallies or late-stage bear market capitulations. This sideways action has allowed the circulating supply to consolidate at a higher cost basis, setting the stage for amplified volatility once the price breaks out. The realized supply density metric highlights that 20% of the total supply is now concentrated within plus or minus 15% of the current spot price. This dense clustering means even small price movements could lead to outsized shifts in profitability and sentiment, potentially triggering sharper market reactions. The sell side risk ratio offers insight into the balance of realized profits and losses relative to the realized cap. Essentially, it's a measure of profit taking relative to the market's size. When the ratio is high, it indicates significant profit or loss taking, often following volatile price moves. Low values suggest that most coins are being spent near their original cost basis, signaling a period of equilibrium. Recently, the ratio has declined sharply, driven by reduced activity from short term holders. This suggests that much of the profit taking and loss realization has already occurred, leaving the market in a more balanced state. Historically, these periods of equilibrium often precede heightened volatility, whether it be a continuation of the rally or a market correction. So, to sum up, here are the key takeaways. First, profit taking volumes have dropped significantly from their peak, signaling a slowdown in sell side pressure and a more stable market. This suggests that supply and demand dynamics are starting to find balance. Second, retail demand is outpacing mining supply. Small holders have absorbed nearly twice the amount of Bitcoin being mined, which shows strong demand from retail investors and highlights a tightening of available supply. Lastly, we're likely heading toward increased volatility. The market is in a historically tight 60-day price range, and with a dense supply concentration near the current price, the market is coiling, ready for a potential burst in volatility. These factors suggest that Bitcoin could be on the verge of a big move, so it's definitely a time to watch the charts closely. And that's all for today's analysis. Thanks for tuning in, and I'll see you in the next one.